Okay, so today we'll discuss Unit 4, Investment Risk and Portfolio Management. Broadly, we have to discuss what is risk and return and how to manage the financial risk. First of all, what is the return? Return is excessive money that you will invest. Any money comes over it is your return. And we can calculate return on investment in terms of figure as amount received minus amount invested. We can take as a percentage return on investment divided by amount invested. A lot of risk we face every day. Systematic risk is because of the market failure, and unsystematic risk is because of the company, if like a system, procedure, engineering, or the way we make products. If we have failures, this is unsystematic risk. Credit risk, like default risk, will give money to people, it will not come back. This is default. Foreign exchange risk, this dollar versus euro, there is a fluctuation. Interest rate will change, central bank will increase the rate, so rate will change. Overall industry will not operate good. Political situation of the country will be affecting the business. This is political risk. Then we have liquidity risk, power to pay short-term expenses is liquidity. So you may lose your short-term ability to pay. This is liquidity risk. Okay, there are three types of risk and return attitude in the world. The whole world we can divide into three kind of investors. One is high risk, high return. Mean they are risk seekers, they invite risk so they can get best out of that. One, like old people, they don't like much risk, so they need less returns. For example, when you retire from your 60 years of service, you need some money to spend your days. So you go to a post office or any other secured place, you will give them money and they will give you a small return every month so you can survive yourself. This is low risk, low return. This kind of people are called risk averse, means they avoid risk. In between we have risk moderate who take calculated risk, so they have calculated returns out of that. We should know for solving the question that there are financial instrument, and any instrument which is backed by government is the most secure. Any after that, anything have a mortgage behind, anything on as a deposit, this is more secure. And common stock of a company is the least secured instrument, because this is a piece of paper issued by a company in a stock exchange. We can buy and sell, but if in case company goes bankrupt, you will find nothing. So this is the most unsecured method of investment. US Treasury bond. First of all, what is a bond? Bond is issued by a company directly to the public, that we are responsible to pay you this much of interest. If it is a serial bond, means in a series. If it is a term bond, then at the end of the term they will pay this much of interest. This is a bond. If this bond is issued by government, US government, this is most secured, because in case this bond does not bring profitability, still government of United States is responsible to give you the agreed returns. Right. Then first mortgage means that suppose you have a gold, against that gold you issue bonds. So because gold is there, if anything happened to the bond market, they goes down, gold is there, so you can sell the gold to recover your losses and money. Okay. This is first mortgage, means first time this gold you pledge or mortgage against issuance of bonds. Second mortgage means that the same thing you mortgage again. This is allowed in US. In some countries, if you mortgage land one time, second time you cannot mortgage it to anyone, right? So in some countries with rules and regulations, they allow second mortgage, means same thing you can mortgage again. Subordinated debentures. What is debentures? This is again long-term liability, means you create liability as a company point of view and take money from the public. This is subordinated. Income bond is a bond, it's against some income. So when we sell income bond, we tell people that look, this money that we are taking from you will be invested here, and this will be, if the income will come from here, it will be given to you. This is income bond. Preference stock is equity. When you issue this equity, you tell the shareholder that this is the agreed amount I will pay to you. As a corporation, we will pay to you. So, in case of liquidation, in case company goes bankrupt, they will sell the assets and the money will go to the preference stockholders. Right? Convertible preference stock means any stock that you issued, but it is convertible into preference. Maybe we issue bonds and we said that this later can be converted into preference stock. Then we have common stock. Common stock is backed by company reputation, but it has nothing on the back. If the company goes bankrupt, first they will give to the preference stockholders. When they sell the asset and they get money, first money will go preference, then for creditors, then other liabilities, and if money remains, then it will go to the ordinary shareholders. So ordinary shareholders are the highest on the list. Let's talk about expected return. Expected return is, we want to see that if we invest in this option or a product or an investment item, what is the expected return out of that? For that, we use the formula like rate of return into probability. We take the weighted average, and in the last we take. So it is like in this question, there are two options, one X and Y. So when we compare both, the expected return for Y is greater than the expected return of X. So based on expected return formula, if we go for investment for Y, this is good. But same time we have to see the standard deviation. Standard deviation means that how much we deviate from our standard promises. For example, if I say you will get $100, but my always word deviate 50%, so ultimately you will get $50 because 50% I say wrong. So same way we have to see the expected rate of return, but we have to associate a standard deviation. Deviation means difference in expected returns. Formula is very simple, variance into probability under root. So this is the same thing you calculate. So this is variance, you will take under root. So you will see that X has standard deviation less, means if we choose X, whatever we are saying, it is accurate in comparison with Y, because deviation, difference of commitment is different. So if we choose based on standard deviation, we will choose X because difference is less, deviation is less, right? Okay, then we can calculate per unit deviation. Coefficient of variation means per unit variation. So you take standard deviation divided by expected rate of return. So you can see, you calculate per unit, Y is giving per unit less deviation. So per unit, per share, Y is better because in total is different, but per unit Y is less deviating than X. Okay.